Hey, what's up you guys, Swan here from Swan Things, and today I'll be walking you through the very basics of stock investing for the absolute beginner. Now I'll be covering 4 different areas here, mainly why you should invest in stocks, how the stock market works and how you can profit from it, basic stock picking strategies, and also how you can get started. So without further ado, let's jump into the video. Now, I know that stock investing may sound like a super risky thing to do, but I would argue that it's even riskier if you don't invest in stocks. A historical study covering different asset classes has shown that stocks outperform nearly all other asset classes in the long term. Chances are, if you're not investing in any stocks at all, you're losing out on a lot of money. In fact, a Trinity study looking into the success rates of different retirement funds show the same thing. Retirement funds with higher percentages in stocks will outperform those with lower percentages nearly 100% of the time. In fact, retirement funds heavily invested in low-risk bonds actually have a much higher chances of failure. This just goes to show that stock investing is not as risky as people think. It's actually quite the opposite. It all depends on how you manage your risk and do your research before you invest. Now, before you put any money into stocks, you'll need to understand how they work. And to do this, we have to go back to its origins. Back in the 1600s, the Dutch East India Company was funding expensive expeditions to obtain high-value trade goods like spices, silks, and sugars. These expeditions were wildly profitable, but also came with huge risks as merchant ships are often targeted and attacked. In order to reduce the risk involved, the Dutch sold shares of the company to the public to generate cash to build and send out more ships. People who bought shares of the company are entitled to a portion of the profits, which is known today as dividends. Since a limited number of shares were issued, the share prices went up as the company grew, and shareholders may then sell the shares to someone else for a much higher price than they initially paid for it. This is known today as capital gains. This ingenious concept was wildly successful, making the Dutch East India Company the most valuable company in the history of humanity, worth about $7.9 trillion in today's value. Stocks today are not so different. When you invest in a stock of a company, you effectively own a tiny piece of that company. So when they make a profit, they can either choose to pay out some of that profit to you as dividends, or they could reinvest that profit back into the company to grow it, hopefully giving you capital gains. Now, a good portfolio will encompass both growth and dividend stocks. But with so many stocks on the market, how do you know which one to buy? You hear the phrase buy low and sell high, or buy and hold, thrown around all the time. And these two phrases are linked to 2 different strategies. Buy low and sell high relates to short-term stock trading and technical analysis, where the trader aims to buy stocks at a low price and sell it off when prices go up, earning the difference as capital gains. To consistently generate profits this way, the trader uses a wide range of statistical data and tools to predict share price movements to determine the best entry and exit points. The buy and hold strategy, on the other hand, is related to value investing and fundamental analysis, the preferred strategy of legendary investor Warren Buffett. Value investing aims to buy into companies with strong fundamentals, which have the high potential to consistently deliver high value in the long run. Once you have identified these gems, you essentially buy into these companies' stocks and hold onto it for the long term, because you already know that the company will do well regardless of market noise. Now, there's a lot of debate on which strategy is best, but in my view, why not use both? Before I get into how I pick my stocks, I like to highlight here that I am by no means an investment expert. What works for me may not work for you, and ultimately, you need to take responsibility for your own investment decisions. Alright, so the first thing I do is to screen through the market for fundamentally strong companies. When people talk about fundamentals, they are trying to determine the intrinsic value of a company by looking at things like its business model, balance sheets, PE ratios, and all sorts of complicated stuff to determine whether the company is worth buying. But honestly, if you're working a 9 to 5 like me, ain't nobody got time for that. So what I do is use a tool called Simply Wall Street. Disclaimer, I am in no way affiliated to this company. It's just a tool that I use that saves me a ton of time when I'm looking at fundamentals. So what Simply Wall Street does is it compiles all these fundamental elements and summarizes them into a very neat graphical score. When you search a stock here, you can immediately tell if it's a strong company just by looking at this chart. The higher the scores in each quadrant, the better the company. Of course, it's always good to be skeptical about their data. So if you click into the stock, they have details on why they scored the companies the way they did. There's also just an amazing organization of very detailed information that you can look through, including things like insider trading, comparison to its peers and to the broader market, and so on. And if you're a complete noob and don't even know what companies to look at, they have filters built in so you can narrow down companies, for example, for high dividends or highest scoring companies in the Malaysian market, on top of so many other cool features. Unfortunately, this tool is not free and it does not come cheap. I'm on their investor plan and I pay $115 a year to use their services. They do have a free learner plan, but I found it to be severely limiting. If you're not sure if you like to commit, they do have a 30 days free trial, so you can definitely check that out. Link in the description. Again, it's not sponsored. Once I have identified these stocks, I then move on to technical analysis to see if now is a good time to buy into the stock. Now there's a whole bunch of different technical indicators you can use, but for me, I've simplified it down to two, the RSI and the MACD. Without going into too much detail, the RSI or Relative Strength Index will tell you if a stock is overbought or oversold. You can see here that in the past, when the RSI is very low, the share prices are also bottoming out, so it's a good time to buy. Conversely, if the RSI is very high, the stock price is likely peaking, so best to avoid buying in. Similarly, the MACD can also guide you on buy and sell signals. A buy signal is the point at which the MACD line crosses over the signal line, and a sell signal is the point at which the MACD line falls below the signal line. Obviously, even with technical indicators, there is no guarantee that the share prices will move in a way that you predict it will. However, I still find it to be a useful tool to better determine entry and exit points instead of just relying on my gut instincts. In fact, before I buy any stock at all, I set a rule that I can only purchase a stock if it's below an RSI of 30 and the MACD is not showing a downtrend. But again, the technical indicators are not a holy grail and they do send false signals now and then. But since I've already selected fundamentally strong companies in the first place, I am not too concerned if I enter at a higher price and the share price falls. In this case, I can always choose to hold on to the stock for a longer term, or even better, buy the stock at a discounted price to lower my average buy price. Notice here that you'll only lose actual money if you sell your stocks at a price lower than your buy price. But if you hold on to the stock, your money is essentially trapped in the stock unless the share price moves above your buying price, which is not a guaranteed scenario. So there you have it, an oversimplified summary of how I pick my stocks. So if you're not confident on getting into stock picking right away, you can still invest in stocks through robo-advisors like Stashaway. Check out this video here to find out why it's such a great investment for beginners. But if you're thinking of dipping your toes into stock market investing yourself, the first thing you need to do is open up a brokerage account. I personally use Rakuten Trade. I know it's been a little finicky lately because too many people are signing up, but I still prefer it because it has a very simple and easy to use interface, and the sign up is simple as well. Now, if you ask me how much money you need to get started, it really depends on what stocks you're going for. As a general rule, you will buy a minimum of one lot, which is equal to 100 shares. So if you're going for something like Maybank, the initial investment will be around 700 ringgit, whereas there are a lot of cheap stocks out there like IGB REIT, the owner of Mid Valley Mega Mall, which is only about 167 bucks for one lot. So you do have to remember that all the brokerages will charge a transaction fee when you buy and when you sell the stock. So definitely keep that in mind. Last but not least, before you put any money into your investments, always remember to keep at least 6 months of your expenses in an emergency fund. It's better to think of your investment capital as money you are comfortable losing, because chances are at some point in time there's gonna be some losses. The important thing to remember here is that if you're investing for long-term success, all this risk can be minimized if you did your homework and don't give in to panic buying or selling. So that's all for my video today. Obviously, there is so much more to stock market investing, which I hope to cover in more detail in future videos. So if you haven't already, subscribe to my channel for more nerdy personal finance content. If you found this video useful, smash that like button. It helps me out a great deal. If you have any questions, do leave it down in the comments below. And as always, thank you so much for watching, and I'll see you in the next video.